Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Hi, well, hello everyone, and welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes. In this group, we learn from and help each other invest in multifamily with a focus on Greater Central Florida assets or potential investment partners. Tonight, we are going to discuss data-driven real estate investing, the science of real estate investing. This is a very timely discussion, as I kind of kicked off with inflation still causing havoc and a Fed that is hell-bent on stopping it. Many economists are certain of a recession sometime next year. Some say we're already in a recession. So now more than ever, we must pay attention to the data. This doesn't mean, like I said, we panic and stop investing. No, it is a fact that a sizable portion of real estate wealth is made during recessions. Why? Because people stop investing for a variety of reasons. They're ready or they're not, but real estate prices drop. They do temporarily, and smart investors buy at a bargain price. What the Fed cannot do is erase the housing supply-demand imbalance over the long term. There is not enough housing inventory, and that has not changed. And tweaking the Fed funds rate is only going to make this worse over the long term. Thus, now is not the time to stop investing. But to do it safely, we must understand the numbers. And so with that, let me welcome our guest speaker, Stefan Svetkov. Thanks for joining us, Stefan. How are you?
Hey, Ray, doing great. Thanks for having me.
Oh, my pleasure, my pleasure. And what I want to do before I formally introduce you, I'd like to ask all of the participants to put their information on the chat. I mean, what I've done in the past, I've had people introduce themselves, and I get a mix of people that want to chat and some that don't. So I think we're gonna, because there's a lot of information here. So I think we're just gonna ask folks to put their information on the chat, not just your POC information. If you want, put a little bit there about where you're from, what you're looking to get from this group, or where you're investing. Really, what brought you here, right? And I think that'll be a good way. And then if time permits, at the end, if some people want to stick around and chat some more, I'm going to stick around for about 15, 20 minutes after the show to just chit chat. Whoever wants to stop. I know it'll be late for some of us, but it's never too late to do some investing and do some networking. So at this point, I'd like to formally introduce Stefan. Stefan Svetkov is the founder of RealtyQuant, a company that brings data-driven and quantitative techniques to the real estate industry. He is on a mission to add massive industry value through education, investment, technology, and analytics. Stefan is a financial engineer turned multifamily investor, analytics speaker, and live webinar host. He holds a master's degree in financial engineering from Columbia University. And during his financial career, he managed $90 billion in derivatives portfolio jointly with his colleagues. So I want to welcome you at this time. Stefan, the floor is yours, my man.
Awesome. Thanks, Ray. That's a great introduction. Can I share my screen? Just making sure.
You should be able to.
Okay, cool. All right. Okay, do you guys see my screen now?
Yes, I see it.
Okay, cool. Yeah, okay, so today's topic, data-driven real estate investing. So it gets a little bit technical in some places. I know sometimes it was the audience with that, but I do want to nevertheless show you the mindset of it and kind of, kind of what's out there, kind of horizons expanding, right? And so forth. And part of it, like on the property side, is more applicable to active investors. I know we have many like passive, potentially like some passive investors. The market side is going to be very useful to them. In particular, just stick around through the through the property portion And so like you mentioned, so I'm a financial engineer by background. In the recent couple of years, I've been a full-time real estate investor. And I'm also founder of a prop tech startup called RealtyQuant. And yeah, so today's presentation, so it's not, formal investment advice. It's, for information purposes only. So we're going to talk about essentially data techniques that are out there on the property side and that are out there on the market side. So that's kind of what it boils down to, the ones that at least I'm aware of, or most of them, or some of them. And right, so introduction. So what is data-driven real estate investing? So it's a few, let's say one of those 6 pillars, let's say. So part of it is, a big part of it is automated underwriting. So automated underwriting is basically if you're able to call it on-market often data. And I know most investors, and that's like very applicable to active investors indeed, but most investors, they like to find off-market deals, and that is correct. But think of that an off-market deal is also a little harder to analyze. Right now, you need to have your acquisitions team kind of analyze those one by one and so forth. And it's not like extremely scalable. And so like on-market automated underwriting kind of via scripts, programmatically is one aspect of that. Another one is now suppose we have off-market inventories, and for commercial investors, multifamily operators, for example. So one thing that I do in my commercial property searches is actually modeling value add for off-market inventories. So that's a great technique. So you can kind of use rental listings data to model that, and I'm going to get to that in a bit. On the market side, I know that like every investor or syndicator, investment managers, they would pick their markets, based on like those, price, income, population, etc. But it's not so data-driven in itself if it's done on kind of a few data points standpoint, right? So you kind of need to do it across the US. You need to pull like, let's say population for the whole US, for every single county or, every MSA, et cetera, to actually start having insights. And you need to also have a historical perspective on that. And and you need to perhaps be running statistical studies. So, and some of those statistical studies are also for downside risk besides appreciation. And I've done like other lectures on like how you can actually pick like the best appreciation markets and so forth. Another aspect is AVMs. And I don't know how many of you have heard AVM is like the technical term. It's an automated valuation models, which is what Zero does. And it's a little bit, has gotten beating in the industry with, excuse me. Yes, it's gotten a little bit of a beating in the industry with Zero kind of losing a lot on its iBuyer division, but AVMs are really, pricing, most in the residential space, less in commercial, pricing houses programmatically. So kind of getting the location of a property, getting like all its other parameters and kind of trying to price programmatically. It's a difficult field, but that's another one. Then there's some machine learning techniques that come into play if you want to classify properties in different ways, such as, let's say, gauge their condition. And so on the language side, there's NLP, natural language processing, to actually try to gauge, classify like properties in different ways, or like in what condition they are and so forth. And on image side, there are like few startups that do like condition scoring for real estate images. So those are examples of like kind of different technology, kind of more modern aspects that can help you build up property analytics, let's say. And of course, this is like, it's kind of relatively advanced, like one may need to kind of hire perhaps people to do it, but getting an understanding or knowing what's out there is kind of interesting. And so another aspect is, okay, what's in my opinion, not data-driven investing, because many people, they would say, okay, we use data to invest, to pick markets, to pick properties, etc. But typically there is a lot of manually underwriting deals. That's always necessary to an extent, because there's a human factor in real estate, it's a physical asset, and you're not going to go by data alone for sure. But in itself, it's kind of not, data-driven. And so, okay, failing to perform analytics on off-market inventories, where let's say you're like kind of blasting direct-to-owner campaigns to multiple off-market properties, but you don't actually subset them and analyze them deeper for which are the worthy ones, let's say. Or selecting kind of, let's say, like a couple of trendy markets and then kind of back reasoning their fundamentals, like that they have housing shortage or that they have population growth and so forth. but not actually doing it across the board. So kind of doing it on a few data points basis and without a statistical study, but just kind of intuitively. So that's also not. And, manually gauging property values or reading, let's say, summarized market reports, be it markets and leadership, et cetera, in themselves data-driven in how they're derived, does not necessarily transfer onto you, like as a person who will actually, internalize that understanding, right? So you kind of need to be building intuition with the data, or someone on your team to be building intuition with the data to be data-driven, rather than just reading summary reports. And utilizing no risk management. That's extremely prevalent in the real estate industry. On the market side, no risk management whatsoever. It just doesn't exist. So no downside risk. It's all about let's gauge appreciation. Let's pick markets that have the strong fundamentals and no downside risk management whatsoever. So I'm going to talk to that part afterwards. And so, so today's topic,
Hey, Stefan, real quick, do you want people to ask questions as you go, or do you want to wait to the end with that? I should have asked you before we got going here.
I would welcome questions. It's okay. We can also do it at the end because it kind of have quite a bit to go through. So it's okay. If anyone has an urgent question or just wants to ask a question, that works, of course, at any time. Mm-hmm.
Okay, so if you guys want, you can shoot it to me on the chat, or you can just jump in. All right, thanks, Stefan. Sorry about that.
Awesome, yeah. So again, like today, get to know data-driven principles, it kind of inspire a new vision, more modern vision for investing, right? So property analytics, some of the things we looked at: automated underwriting, property condition scoring, commercial multifamily modeling, and AVMs, and market analytics, kind of the concept of valuation metrics, and some recession-backed studies I'm going to share about. So property analytics. So on market, the least popular topic with perhaps active investors on the property side. Everybody hates on market, but one can find deals on market, I think. Why? Because think about it, if you're doing it programmatically, if you're pulling thousands and thousands of off-market listings, you do it every single week, are they going to match to what agents, well, technically if agent gives you a deal, it's also on market. Are they going to match to what agents give you in the let's say, fraction of deals, call it, that you're going to see from that source? Perhaps no. But there's the aspect of, okay, if you have better returns in the off-market space, or better returns on a lesser likelihood, because you're simply not going to be able to underwrite so many deals, or you're simply not going to be, or they're just harder to underwrite, such as they're going to be an expense to underwrite to have a team to do it, and so on and so forth. Then you may capture less of those. So arguably, basically, what I've been doing, like myself, both before as a residential investor and now on the commercial side, personally, is actually pulling a lot of on market as well. Actually, all of the on market. So I do want as a basis to have all the on market underwritten entirely, because I'm able to do it programmatically, and from there build on with all the other, all the other off market, etc. aspects and agent relationships and so forth. And that's been working well for me, because if you actually underwrite thousands of properties, you're going to find the top 0.1%, even if they're all basically garbage, which they are generally, but there are exceptions. And so that's one aspect. So that's kind of pulling from, and this was this presentation here is more focusing on the residential side, because it's more typical there, but it's really the same thing if you're doing WhoopNet or Crexi and so forth. So the goal is kind of end-to-end underwriting, kind of having it fully automated. And then on top, you would still do human underwriting, but you want to get as many calculations and stuff up front. There are also different APIs that can give you various rental listings or listings data. One is Datafinity. So they're vendor out in, I believe, maybe Austin. There's Tovo Data, and there's some web scraping companies as well that one can use, Scrape Hero, etc. And, it kind of involves programming and building a few functions where you would want to get sort of structure a search query, for what you're actually looking for, collect the results of those searches in terms of URLs, and extract that data and so forth. It's fairly, and then analyze it. And it's fairly straightforward in that way. And there are ways to do it with no code, again, with some of the companies that I mentioned above partially, or there are also no code web scraping tools. Okay, so challenges in non-homogeneous data fields, large data sets, lack of discrete fields, etc. Condition scoring, you're not able to do well just like that. It's like basic calculations usually. Multiple data sources, kind of, again, like to the non-homogeneous part. But the outcomes of that are, okay, you get to analyze like thousands of properties and kind of have them ranked. And it's really doable in the commercial side as well. And it's easier on the commercial side because on the commercial side, you have just fewer listings. It's harder on the residential side. And then it's the hardest if someone went to invest in single family or something, which I've never done personally in that sense. And okay, but an aspect that actually technologically facilitates automated underwriting is condition scoring. So what will perhaps ultimately break through in automated underwriting over the next even maybe 1 year is going to be like what is now referred to as large language models. So large language models, so they are kind of being able to understand like big chunks of text. If you think of something like the SAT, like standardized testing, let's say, and you have like complex text that you want to understand and then actually answer to that. So that's something that is like done by large language models. So those could potentially like essentially break underwriting altogether to a point where you would not need analysts. And that seems to be very, very close based on some of the recent developments in large language models. Okay, but the step towards it that is already has been available for a while is condition scoring. So condition scoring is okay if you want to underwrite 1,000 properties, but you want to actually understand, you need like a sense of in what condition they are, because otherwise kind of meaningless just looking at return numbers and so forth. And so that can be achieved on the textual side with different like natural language models. So they're open source, some of them available in Python. I use some of those. I use TF-IDF. There's also BERT, which is better. They all are like technical, include like involve using technology in that sense. But what they give you is actually you're able to kind of score descriptions that, let's say, real estate agents give of properties and classify them, let's say 1 to 5, 1 being great condition, 5 being very poor condition, and so forth. And on the images side, there is a company in New York called Foxy AI that they're doing a great job condition scoring images. So if you, for example, submit the properties of the images of your property, they would score it. And that score likely would align with your intuition if that's a property in great condition or very poor condition. And so that's useful because if you think about it, that's what's holding to an extent automated underwriting for many, many properties, because you can run calculations on them. If you have some data on 1,000 properties, you can compute the cap rate, cash on cash return, stuff like that, under some financing scenario. That's fairly straightforward, but what you can't do is like get the condition right. And so if you want to, let's say, perhaps put some renovation estimates, it's a very high level modeling, but again, it's useful if you want to rank many properties. And commercial multifamily. So in that one, as like some of the active investor part of the audience know, like commercial multifamily is valued by the income approach, well, predominantly, sometimes ends up a mix with other approaches, right? Such as even comparables in few cases of smaller commercial multifamily, etc. But generally the income approach. And so you have the net operating income of property divided by the cap rate or capitalization rate. And that's what gives you the value of the property. And so the question then being, okay, how do you in a data-driven way analyze commercial multifamily, let's say off market? Because let's say a lot of the commercial space, especially a lot of the stuff is off market. And well, agent relationships even more than that, but okay, and off market. And so, and how do you scale like that? And so they're like different vendors that would typically give you like data on commercial multifamily. So I mean, there's CoStar, incredible data. I recently did a call with them myself. I didn't sign up myself, but it's a great service, no question about it. It's incredible. Okay, then you have Reonomy, RD Matrix, Prospect Now. And that. And so the question though here in a data-driven way is, suppose you have a set of markets that you want to invest in. Let's say there are 10 of those. And each of them has like 500 properties, commercial properties in those. Now the question is, do you care to know which are the better ones in those or not? Maybe no, because you can say, I don't care about direct to owner. I just care about agent relationships. But suppose under scenario you do care about direct to owner. In your specific niche, you're actually looking at that. So one thing you can do is model the value add of those buildings based on their rental listings data. For example, rental listings data is predominantly available on apartments.com because that just happens to be the CoStar rental listings resource. So that's the best one. And it's also one can be purchased from various vendors such as Datafinity, etc. And so how do you derive insights at scale? Now, those insights are less good because they're at scale. You can't get them to right. You get them a little bit right. But if you get them a little bit right, you can kind of rank properties and so forth. And so you can study rental listings data for which buildings are going to have the biggest percentage value add, because that's what I care about as an investor. I want to know, like, am I going to raise the valuation of that property 30% or not, or 15%? And so that's kind of like what they want to rank on. And so you're able to get insights into that from rental listings data because we see like some of the rent levels. Now they're listed rent levels, but still relative to the immediate neighborhoods and unit mix. And you also see some of the other income components. What fees are they charging? Pet fees, parking fees, storage, etc., administrative fees. You can get a estimate of the occupancy rates, and you can see what utilities are being billed to the tenants or not. And the benefit of that is you can do it for instance, I did a lecture at my webinar where I showed like doing that for like 32,000 properties. And their commercial multifamily, they may have 200 units, they may have 100 units, etc. And so that's very scalable. And so the steps are, okay, you kind of need to get that data from some source, be it an API or like web scrape it or whichever way would be appropriate according to your internet attorney and so forth. And then, model it and produce like readable summaries. And from a modeling perspective, you actually want to estimate how much you can improve the net operating income based on like some of the components you saw. Are rents below market? Are other income components underutilized compared to the same class buildings in the same neighborhood and so forth? And that's actually a product that it's been released at RealtyQuant at my company recently, if you guys want to check it out. And so that's like, so you kind of get properties ranked, and in the end you kind of have like a ranking of them. So that can be useful. That's what I use in my own like direct to owner marketing for commercial multifamily personally. Now, validating the model, okay, so there are some challenges to that. I'm not going to get into that. And so AVM, so I mentioned before, AVM is like the most famous thing, there being zero's estimate, like it's more in the residential space, less in the commercial space. It's useful for lending, in the lending industry, in like marketplace estimates for iBuyers, home value, other estimators, etc. And so those are like few different companies that use AVMs on the prop tech side or like real estate technology side. What are some investor applications? By the way, that's like with 5 lines of code to the right is like a very simple, well, it's custom training, very simple way to do it in Python. And again, I know most people are not going to do that, but it's just like kind of to see like kind of what's out there. It's actually fairly easy, like few lines of code to build a very basic AVM that tries to kind of price houses in the neighborhood. And it's not going to be perfectly accurate at all, but it's going to be, a little bit give you a sense. And the value to the investor, I used to use this as a residential investor in the New York City area to search for mispriced properties upstate New York, for example. So you can we're very liquid markets. You're in very liquid markets in some places like in the Midwest or perhaps partially to the south and northeast, perhaps in very liquid markets where properties may be very mispriced. And that, sometimes you can kind of capture some of those outliers with AVMs as an investor. You need to have like very homogeneous housing stock, and the benefit, like the way mainly they work, if you think in real estate, it's location, right? Location is the most important thing to real estate. So if you value it kind of, you need to be able to have some non-linearity in the numerized location. So the location is numerized via which are geo coordinates, let's say, right? That's kind of nonlinear because you can have very nearby geo coordinates that are a rough neighborhood next to a pretty good one. And so that's where some of the machine learning methods are like what here, for example, I use like gradient boosting kind of method, come into play. But that's a basic version of an AVM where you can actually hire someone to build it for you if you want it. It's not super hard, but getting it really right and getting it across many markets right, and that would be very hard. So that was property analytics, so just kind of for impression. It's very technology-oriented perspective. Getting onto market analytics, it's more like finance. Like for me, let's say coming from the financial industry, it's more like finance applications. It's a very interesting topic, extremely hot right now. I've been talking about market analytics on many different events, and it's extremely interesting. So the reason why it's very interesting is, okay, if we have a, let's say a recession, and it's kind of a word scares people off, like gives a little bit of like fear factor or something like this. But the question for me really as an investor, and like very much to Reyes' point at the beginning, actually. So as real estate investors, we know we are kind of value creating, right? We are not actually, I find it funny that the word real estate investor is actually not maybe perfectly accurate in the sense it's not actually pure investing. It's not investing as in the stock market. It almost implies you are just merely investing, while you're actually a business operator of sort, because you are creating value, adding value to the property. If you're on the commercial side, creating forced depreciation or adding value in different ways. And now you're able to do your forced depreciation in a recession. And to Reyes' point, you may be able to do it better in a recession because just simply other investors pull away from the market. There's a little bit of reduced pricing and so forth. So you might get benefits on that, on your business, so to say. Now, you likely would not get benefits on your pure investment or sort of market perspective, because that one, could be going a little bit down or just be very stagnant and so forth. But what this is getting into is, okay, even though you can have like an incredible business in a recession, okay, well, where to invest in which market so that you don't have the market side offset your incredible business efforts of gaining forced depreciation or successfully buying discounted properties. And so that's this study. And so this is a table with a lot of numbers. It kind of gets a little overwhelming, perhaps. But what it's really showing is, the studies that I do myself are very much revolve around market valuation. So here, I think I mentioned it like at the bottom, so methodology, essentially market over under fair valuation. So I try to estimate, it's done. You may have seen Mark Zandi, who is the chief economist at Moody's. So he does it, actually. It's very much done at the institutional level. And it's also done at Florida Atlantic University. It's done at Bloomberg Economics for different countries. And so what I do though at RealtyQuant is that I actually do it for every single county in the US and every single market. And it's actually, the data is available for like close to 3,000 counties at RealtyQuant.com. And so, okay. And so it kind of hinges on like how over under fairly valued the market is. And that's what this table is showing. Not to get too bogged down with like too many numbers. It's actually the leftmost column. All that it is, it's like how overvalued the market was ahead of a mild recession. That was 1990. It was a perfect example of a mild recession. And ahead of a severe recession, the global financial crisis. Now that those are a mild and severe recession, why do I say they're so? I mean, there's an economic research unit called like Pew Economic Research, for example, relatively well known. They put out an article. You can perhaps Google it, and actually use in terms of where the global financial crisis, perhaps like one of the most severe recessions in the past 2 centuries, and 1990 had a very strong economic recovery, or relatively strong economic recovery. And it was a mild one, and the global financial crisis economic recovery was very, very weak. And so it's also in 1990, if you look at something like the Case-Shiller Index or FHFA, this here I use FHFA, Federal Housing Finance Agency for prices, the governmental agency. And so if you look up 1990 and you look at the whole US index and how much prices declined after the recession, 0%. So that's almost a non-event. If you speak to like most investors, there could be someone who is in the wrong market perhaps, but generally nobody knows about 1990, right? But if you look at the data at a deeper level and you actually segment which markets were overvalued then, you start seeing different things. And so that's what I did. So I did actually segmenting The markets which were less than 10% undervalued is the bottom row, undervalued. Then less 10 to 0%, 0 to 10%, let's say fairly valued, and so forth, and up to 50 to 60% overvalued. So even though the broad market ahead of that mild recession was actually undervalued, and it declined nothing, 0%. At the time, there were overvalued markets, and in the 50, 60%, for example, at the state level, let's say, and there are different MSAs or metropolitan areas, at the state level, broadly Hawaii had some of those markets, California, Oregon as well. There were some in Massachusetts and New York even. But that was like Hawaii was a very pronounced example. And so what happened is that there was a very different price performance on the downturn, and also like the 10-year ahead. So what this table is showing is what was price appreciation 1, 2, 3, 4, 5, 6, 10 years ahead. And so, and then during the global financial crisis. And so kind of like to break it down for you, because it's a wall of numbers. Let's start with global financial crisis. There's the column of overvaluation is the leftmost column. And so the column average peak to bottom declines, how much those markets decline. So a market that was over 80% overvalued ahead of the global financial crisis, such as few in California were at the time, declined 52%. But a market that was less than 10% undervalued declined only 4%. And so the order of overvaluation and the declines that happened was extremely strong. And that I've spoken on like different events, and that's been, I have it as an article on my website as a study that actually the correlation at metropolitan areas of those two, how overvalued different metro areas were and how much they declined, was 88%, extremely strong. So actually, if you invested in undervalued markets ahead of the global financial crisis severe recession, you got a 4% decline or a 6% decline. And if you invested in overvalued, you got a 40, 50% decline. And the ordering of that, it was perfect. There is no exception. You get the more slightly above 10% above bucket, declines more, slightly above 10% declines more, and so forth. That was the global financial crisis. Decline durations, how long it took? It took a very long time. So let's say the market was overvalued 50%, let's say, ahead of the recession. It declines 40 odd percent. It takes 5.5 years to decline. The decline durations is something that doesn't come from it. That's just price histories. That's how long it took. It took between 2006 and 2011, sometimes 2012, 13 for prices to actually bottom. That's during the global financial crisis. Now, if you think that decline durations are very long, simply based on the severity of the recession, that's actually not the case. There are other drivers of that. But decline durations typically after also a mild recession can be long. And so that was the scenario in the downturn after the global financial crisis. And in terms of what happened afterwards was where all the overvalued markets 10 years later, they still hadn't reached their prior peak. They later reached their peak and surpassed it. But it took, let's say if we take, since we're speaking like to a Florida meetup, right? For example, Florida prices peaked in 2006. And they actually were, they reached to the 2006 levels in 2020 at the state level. I don't know, that could vary. I'm sure that's a little bit earlier in a few like MSAs, but at the state across Florida, the state level, they actually reached in 2020. And then they went quite ahead over the past years, like well ahead of that peak. But until then, for let's say the first 10 years, the prices were below that. And that's because Florida was very overvalued in the 2006, in 2006 as well. And so performances, like basically at 10 years ahead, you're still in the negative basically. But in undervalued markets, if you're in the most undervalued market after global financial crisis, 10 years ahead, 25% up. So still some kind of upside. And that's only 10 years ahead. After this, it's a different kind of perspective. Okay, now the interesting thing, I think like for many people right now is what would happen in a mild scenario. So what, from me, my speaking to investors, what I typically hear is, say one wants to invest in something like Austin, Texas, a very booming market. And we're going to get to which markets are overvalued. Austin, Texas is around like 50, 60% overvalued, by the way, in this study right now. And so say like Austin, Texas, got incredible fundamentals. And so we're going to invest there. because, okay, I don't want to invest in something that's extremely stagnant, like the Midwest, call it broadly, it's a stereotype. I want to invest where it's going to decline only 10% in the recession, let's say in a mild recession. I'm fine with 10% decline, but then I'm going to get an upside of, let's say, 40%. That's the typical mindset that I hear in terms of expectations for a mild recession. And that decline durations are seemingly, they're going to be very short. So that's not what the data suggests. So investing in a market that was 50, 60% overvalued ahead of a mild recession resulted in the longest duration of decline, longer than the global financial crisis. Why? So think about it. You invest in a market that's 50, 60% overvalued. It declined only 14%. That's at that time. Why it declines 14% first? And second, why does it take so long? Why does it take 6.5 years? It's very interesting. And so it declines only 14% because if you think of real estate declines, that they typically do always take a long time, like 4 to 6 years, or 4 years at least. Over this time, if you have a strong economic recovery, the fundamentals catch up with, basically reduce your overvaluation. So they kind of increase over this time. And if you think that this overvaluation, again, it's based on, it's based on like deviation from fundamentals of income, population, and housing supply. And so those fundamentals of income, population, and housing supply, they catch up. And so in a very mild recession, that catch up is very significant. And if you have something that's 50% overall, it declines only a little bit. But if you have a severe recession like the global financial crisis, because the recovery was so weak, it's not that that one is a crash. I think it's not actually the dynamic that is truly happening, that it's a crash. It's that incomes were they declined, they were lower, like even a few years later. So since there's no recovery of the fundamentals, you actually end up with the full decline, the full-blown decline of the overvaluation. So if someone wants to forecast, which I'm not into the business of doing that, if someone wants to forecast, okay, which scenario is going to happen, the left one or the right one here, it comes to general economy forecasting. It's like forecasting income growth. It comes to like these broad economists would forecast like how strong the economic recovery could be after, if we have an officially declared recession, which we don't have yet. That's another topic. And so, but that's what it comes down to. And it comes down to knowing overvaluation, which you can know, and you can look it up at RealtyQuant.com, or because probably you're not going to pay for Moody's or something like that, or I don't know how it works if Moody's provide it. I don't think they do. And so basically, that's why in a mild recession, you can get much smaller declines for very overvalued markets. But now the thing is this decline a short one? No. Why? Because think of something being overvalued 50, 60%. You have a mild recession, you're not going to be getting, you're going to be getting fundamentals recovering quite a bit and compensating for the overvaluation. But you have something that's going to end up in something that's going to end up with a small decline of, let's say, 15%. But you're actually going to have it decline perhaps for a longer time, because it's just going to take a while. It's going to take a while for all those fundamentals to catch up. And so that's what happened in Hawaii, for example. So Hawaii was close to 50% overvalued, the whole state. And by the way, Hawaii was the most booming state ahead of 1990. So it's something like the equivalent of current Idaho. And so it had like triple-digit appreciation ahead of that. So which investor in Hawaii is going to think we're going to get a mild recession, that basically almost nothing happens to broad US real estate, but our incredibly booming market with strong fundamentals is going to slow down for 8 years ahead. So prices in Hawaii were 8 years later, 14% less. The reason for this is what this table is showing, because Hawaii was 50% overvalued. It did decline 14%, actually. It was the same number, kind of, it's in this table. Well, it took a really long time. And so one thing, like for investors now investing in some of the Western markets, which are particularly overvalued, is actually that that they think that if we get a mild recession, we're going to get a small decline. Yes, I agree. But that's going to be fast, or that their market is going to afterwards outperform the rest markets is actually not what the data suggests. Because what here happens is the market becomes stagnant for a really long time. And so 10 years ahead, it's the worst performing bucket. And so even after a mild recession, with the extremely small declines, these small declines take a very long duration, the more overvalued the market is, and an extremely short duration for the undervalued ones, close to zero, in fact. You see like close to zero decline duration in years in the most undervalued bucket, increasing up to 6.5 years in the more overvalued ones. And so, and in the global financial crisis was like more like 5-6 years in overvalued ones, and then the undervalued were like 2-3 years. Still shorter duration, but kind of still significant because it's a severe recession. And so, but what we see is that the most undervalued bucket, and that was a surprise for me when I did this study, I was expecting a slightly different result. You can get that the most undervalued bucket outperforms consistently, and the ordering is almost perfect. So this table is almost like physics or something. You have like a perfect ordering of time and kind of valuation and magnitude. It's like
Stefan, there's a good question that I think is relevant to this chart and maybe some of the other charts. So I guess when you're looking at this chart, you're really looking at all
this is the main
real estate
chart,
or residential real estate based off of I guess your typical way that a market takes a look at this. I mean, my question is, or at least the question that I have from Vesey is, how do you have a chart that deals specifically with multifamily? Because when we looked at data from 2006 to 2000, let's just say 2010, the single family housing took a beating. It took an absolute beating, but that didn't really reflect on the multifamily side. So I'm just curious if you've got some chart that kind of breaks it out, or some other way to analyze the differences.
Right, that's a great question, and unfortunately, no. And I do look at commercial multifamily a lot, and I looked at like theoretical cap rates and how one can forecast those and try to get a sense of some of that. But unfortunately, there simply isn't such credible data on the, on the commercial multifamily side as the housing market. So no. Now, one thing I want to say to that is, I feel like commercial multifamily investors, they tend to say that, oh, it's very recession resistant because after global financial crisis declined very little. Well, during the global financial crisis, now the housing market was very getting boosted by excessive lending and so on and so forth, and perhaps commercial multifamily wasn't, but that's not necessarily going to be the case now. If we take, the markets that experienced double-digit or perhaps 20% plus annualized rent growth, now rent growth, or call it net operating income growth, is a huge input into theoretical cap rates. So that drives cap rates enormously and it drives them down. And so if you think of like that rent growth, and if I was intuitively, so I have no studies in commercial whatsoever, this is just the housing market. Okay. But if I was, do I use this when I search for commercial properties? I actually do. So one reason is I looked at like CoStar commercial index for just the residential sort of multifamily commercial. And then versus FHFA, they do have a 91% price correlation kind of over the long run. So one, they're not so loosely correlated. Now, I agree you would get a different result in commercial, but is that result going to be milder? Not necessarily at all. In fact, one may think that the current conditions, they might be more conducive to commercial overvaluation, because I do not personally know of conditions bringing the housing market to be overvalued, as I would show in a moment, and to what percentages it actually came. Inflation drives it to an extent, but I've seen it more on the commercial side with rent growth. And so the situation where like commercial multifamily is more recession resistant, I don't think there is anything like that that's recession resistant. I think it comes down if things are overvalued or not. And perhaps the ahead of the global financial crisis just wasn't, but it can go the other way. And so, yeah, so that's like just like a lot of numbers, but it's interesting, long decline durations even after a mild recession. But typically, if you have something overvalued, in very short decline durations after a mild recession in undervalued, things kind of jump back and it outperforms. So that's what studies suggest. Now, in those scenarios, we can have a different scenario, and I think it's possible. And so those are like some of the observations on price performance. So 1 through 10-year horizon, the more undervalued, and these are metro areas, outperform consistently in a perfectly ordered way. On a 10-year horizon, basically like some of the percentages that I mentioned, and undervalued less than 10%, which that bucket currently doesn't exist, actually was the best performer. Declines in decline duration, so also almost perfectly ordered after global financial crisis, and even the mild 1990. Strong economic recovery makes you to actually to resolve the overvaluation and end up with a small decline, but it takes longer sometimes for that small decline. And so that's kind of interesting. And a severe recession with weak recovery, you end up kind of perhaps with the whole magnitude of the overvaluation. So that explains kind of some dynamic as to why you may have a bigger declines or smaller ones. It's not that one is a crash and the other one isn't. It's just driven by how strong the economic recovery is. And yeah, under and fairly valued MSAs, extremely small price declines in either scenario. Mild, severe recession, very small price declines. It's an extremely consistent observation. Ahead of the global financial crisis, there were over 100 metropolitan areas that were undervalued. The average 6% decline. Extremely consistent observation. It's if you invest in undervalued, the likelihood of price declines on valuation are very low. You can still in a individual kind of undervalued market, you can get a decline that could be due to the fundamentals deteriorating. I think it's what seems to be the risk now for something like San Francisco, where it's got massive population outflow. And so that's perhaps driving some of its kind of like price downturn potential and so forth. And so like, so most kind of like overvalued MSAs, you may have heard like charts from like people like Chris Krohn and so forth, like some of the real estate gurus who are like quoting like different studies. And so this is my study. So this is RealtyQuant data. So Boise consistently is the most overvalued city in America. It's been like that since 2020. And I personally have been tracking it since 2020. It's been changing and the overvaluation has been increasing a lot, where at the end of 2020 was at 45% overvalued, and now it's like up to 84. Few other cities in Idaho, you know, or MSAs in metropolitan areas in Idaho, Texas, Arizona, Washington, Florida, Utah are in the list of kind of the top 10 ones. Since we're at Florida meetup, I'm gonna kind of mention some of those. And so we have, so these are the top tables, like the top 5 Florida most overvalued MSA. So it's Tampa, Cape Coral, Lakeland, was it Punta Gorda, I guess, or Northport. So those are like 45 to 49%. And the bottom ones are the least overvalued MSAs actually. So like Tallahassee, Gainesville, and etc. So that's kind of how Florida looks. It's actually interesting to see, just to come back here into the prior table, and that's exactly the mild recession discussion. If we got now a recession that, let's say, mirrored 1990, Boise, and that's like a precise regression of what happened in 1990, Boise would decline only 19%, even though it's overall 84. Now, what's going to happen to that decline that is only 19% for 84? It's probably going to take a really long time. So the prices could be dragging for 8 years, but it's a very mild one. And so that's why I'm not like particularly like negative or something on like something being that much overall. The percentages sound kind of scary, but it can be pretty mild and very small declines, you know, even in the most overvalued ones. Now, if we got a severe recession, then that's looking at a very big decline just because it's very overvalued. But the question is, but the point that I'm making, one point that I'm making is actually in both scenarios, it's a secondary question how much prices decline because you relatively they underperform. And that's what that table with a lot of numbers previously showed. Most undervalued MSAs, not particularly exciting ones, you know, but they actually, those are undervalued right now. So in MSAs, metro areas in New York, Pennsylvania, Louisiana, Maryland, Illinois, North Dakota. So some fairly valued. And again, you can see like these numbers have been increasing a lot since Q4 2020. So actually, if we're having this discussion at the end of 2020, US real estate broadly was fairly valued. If we're having this discussion now, these are some fairly valued markets in California, New Jersey, etc. If we're having this discussion now, nearly 60% of all MSAs, and that's at the end of the second quarter only, actually, are overvalued to over 10%. Nearly 60%. So overvaluation is actually more spread out than 2006 already now suddenly as of 2006 to my surprise of Q2 2022 compared to 2006 to my surprise too. And so it's like nearly 60% of all metro areas are overvalued, percentage higher than 2006, and just under 12% are undervalued, percentage way lower than 2006. 31% of the metro areas were undervalued in 2006 ahead of the global financial crisis. The overvaluation, though, on average was higher then. So higher average overvaluation then, but a different distribution and more spread out overvaluation now. And it's interesting, we're actually getting to this level because we're coming from where, like, I was doing like a lecture like this one in 2020, and the lecture, the narrative was US real estate is fairly valued. And that was the narrative, that was Bloomberg Economics, they had a study, and that was true even the first quarter of 2021. And just over the course of 1 year and 1 quarter, then coming to like pretty high levels. Now, one thing to mention though, investing like more overvalued markets ahead of a recession can be extremely profitable, as many of us have learned in this market cycle. So 1 year ahead performances are extreme, can be way higher, not always. So ahead of 1990 recession, overvaluations that had happened kind of more than 2 years before the peak. But let's say ahead of the global financial crisis, if you invested 2 years before the peak, 1 year before the peak, your 1 year ahead performance is going to be the stronger if you invest in overvalued ones. And so that's kind of, so they really outperform in the short run. But on a 10-year forward horizon is a different story. And that's what this table is saying. This table is actually saying that this table is like averaging each of 5 years before the peak, investing at each of 5 years before the peak overvaluation, and what 10-year ahead performance you got. So what this is trying to get to, just the gist of it is, well, what if we now don't get an officially declared recession by NBER? So, and let's say we get it in 2 years. Now, if I invest for 10 years on a long horizon, most investors, and especially, value add and so forth, we don't invest for 10 years, right? But let's say if you invest for the long run, for 10 years ahead, where are you going to outperform? And what this is saying is that even if you didn't invest at the peak, but you invested in overvalued 1, 2, 3, 4, 5 years even ahead of the peak, even though in the short run you would outperform sometimes for this table, over 10 years horizon, again, the more undervalued ones outperform. So there are realities of kind of value investing, like what like some in the stock market, like people of, like historically, like many years ago have been saying, like kind of like what Warren Buffett does in the stock market. Like there are realities of value investing that buying overvalued has an impact over the long run. And it's not just about, what investors are worried about, am I going to get a bigger decline now or not? It's more like the issue is that you're going to outperform, like the top percentages here underperform, are very low, and the other ones are much higher. So there's a relative performance question. And another thing is, okay, if we're getting price peak, shouldn't we get, considering we have these valuations or overvaluations, these are normalized prices. So actually at RealtyQuant, for people who use our data, they actually get the history of that. So they get, it's not like something, it's overvalued like a label, like a market. It keeps changing. And so you can track kind of the history of that. And the question is, one of the signals you want to look out for is, if overvaluation peaks and kind of starts declining, that may be a little bit of a leading indicator for price declines. And so for those 2 recessions, and again, we don't know what's going to be now, but just two recessions, mild and severe one. So for overvalued markets, the lead time was 3 quarters. So 3 quarters, and now overvaluations have not started to decline yet. It's Q2. Perhaps they will decline in Q3, maybe a little bit. Let's see. But it's of the second quarter they still haven't. But typically 3 quarters ahead, they kind of start a little bit declining ahead of the price decline. That's what happened in those scenarios. And so the big table that I was showing, essentially, one thing that it implies is housing market likely to change regime. In the sense that if we away from, I would say just for 10 years, not like over a bigger term, but just for 10 years, if we did have even a mild recession likely to change regime away from the US West and South regions and into Northeast and Midwest, not like they crazy well perform, but that they outperform. And so that seems it seems like under both a mild and severe recession, because that's, if we think of the broad US regions, so there are undervalued markets to the south, indeed. There are almost no undervalued markets to the west, almost none, almost zero, but there are to the south. But if we hold like broad discussion, I would say the Northeast and Midwest, they're in the -10 to +20% range. So they're the bottom 4 buckets here. So the likelihood that those 4 buckets outperform the top 4 buckets, which are west and south, which are the 20% to 60%, it's extremely high. If we get even a mild recession. And those are like some of the reasons of the explained here is that the smaller decline we get, the longer it takes. And so that's either way dragging your relative performance. And so essentially what that's suggesting is what many investors now that I speak to who invest in maybe Idaho, Arizona, Utah, and so forth. So they would say, oh, we are in the top, the strongest fundamentals markets. I get that. They are the strongest fundamentals. That's why there is a high correlation with overvaluation and strong fundamentals, by the way, towards the end of the market cycle. And that correlation, in fact, I've actually measured it. And it's in fact like of the order of close to 86% at the current time. And it's been like around like 90% ahead of prior recession. So towards the peak or the end of a market cycle, and I don't know if we're still at the end this market cycle, but for prior ones, we get a very high correlation of, let's say, how overvalued something ends up, and that it's actually very strong performing too. And it's very strong performing also because it's got incredible fundamentals. It's got housing shortage and it's got population growth. But again, if those fundamentals get exceeded by 20% or they get exceeded by 50%, according to how much they got exceeded, you get a relative performance kind of expectation 10 years ahead. And so what this is suggesting is that, sure, I would expect, so after this period ends, then whichever markets have extremely strong fundamentals, they would come forward again, just like Florida did after global financial crisis. It's just the consideration is it's not a short horizon for that. It's not what people expect, oh, it's going to be 2 to 4 years. It's more like, well, for 10 years ahead, you're dragged down because declines only take 5 years ahead. And you're overvalued so much. So it's kind of your relative performance is down. Your better economic fundamentals, they compress in a recession. So your outperformance in fundamentals compresses. Your overvaluation is standing at already 60% for relative to the most undervalued bucket. Let's say if you're at plus 50 versus minus 10, and you have those 60% to be overcome by those compressed, on a relative basis, compressed differences in economic fundamentals. And so if, let's say, Phoenix has stronger economic fundamentals, but it's already 60% gap between it and something in Pennsylvania, it's a little bit not intuitive that not so strong markets actually may actually outperform, but that's what seems to happen then. And it's actually interesting that, so it could also reflect some rebalancing because, markets after they're kind of live organisms, so to say. And so eventually like some people start rebalancing into some of those. So for example, an interesting one can look for signals to that. Johnstown, Pennsylvania, which is, one can say middle of nowhere and not the hot market, the least hot one for sure. But I can tell that in Q2, actually prices there increased by 10%, which was odd. That never happens in the Northeast. It's extremely odd. So why does it happen? Because it could reflect like a short-term rebalancing, maybe of like a few investors already realizing that things are too expensive elsewhere. Similar thing happened in Ithaca, New York. Upstate New York is extremely depressed. It's not going to see like particularly big increases, but Ithaca actually had a 10% increase in Q2. And I'm not saying that's something I would bank on. I definitely wouldn't, but I'm just saying some potential rebalancing could also be driving that. And okay, and so that's like seems to suggest even if the West and South happen to be the booming ones, the next market cycle, again, which can be the case, there's no forecast to that. It just takes time. And so ahead of the more productive time of the next market cycle, if we look at just from current peak, whenever it occurs on a 10-year ahead horizon, they seem likely to underperform. And that's something that's what I see in the data. And so okay, and then so that's based on, again, like back studies, like I mentioned, from 1990 global financial crisis, 88% correlation between overvaluation and how much the market declined afterwards. And that's a decline that takes 5 years. So think how fundamental it is to have a number 5 years ahead of time, and then 5 years later, gradual bleeding out, and the two numbers kind of meet. So that's interesting because there are reasons. That just means, okay, fundamental analysis works. Why it works in real estate? Well, it's a simple asset that's driven by income, population, housing supply. It's not the stock market, where you have Tesla or something like that, where fundamental analysis doesn't work well. For instance, I'm not able to do it there at all. And so, but in real estate, it's actually fairly easy. And so 1990 recession correlation was 60%. So 60% is kind of low, but think about what actually what is being studied there. 70% of the metro areas were undervalued. Those metro areas, you have like the bulk of the metro areas, 70% undervalued. Undervalued, as we discussed, they decline almost nothing, close to zero. So you have a big chunk of your set declining almost nothing. And then the rest 30%, they're fair to overvalued, and they kind of decline according to that. And so your correlation is 60% in that scenario of like the deeply undervalued market. And so that's like extremely strong, I would say, for in that sense, if you think of like what is actually being compared. And yeah, so that's about it. So summary, so, you know, various techniques can be used by active investors on the technology side, can relate to like few like prop tech startups, like my own even, or like Foxy AI that I mentioned. There are other startups that do like neighborhood predictions, for instance, and so forth. So they're like different data-driven tools. Market valuations are kind of statistical fundamentals of downside risk, but they also can be used to optimize relative performance. And so it's kind of a new vision for our mindset, you know, for real estate investing, a little bit more modern one, and that's all. So that's like, those are some of the ways to reach to me. So market valuations data for close to 3,000 counties is available at RealtyQuant.com. We have like some lead generation for commercial multifamily. If you want to invest with us. I also teach a data-driven real estate investing course, and I have a YouTube channel. So that's about it. So if you guys have any questions, let me know. Probably went over time.
Man, that's a lot of information. That's good stuff. And listen, yep. I think it's important for everyone to understand that, you know, that essentially when we have these downturns, they kind of impact everyone, right? It's not like you can put your money under the mattress and you're going to make money that way, right? So the idea is figure out where the best places are, study the data, don't overpay. We're looking right now at some of our deals where we're getting 10% reductions on offers that we're working on, because we expect that this is going to be the case. So you still have to buy right, no matter where we are, whether we're on up, down, or up market or down market, you have to buy right. I think the difference is that when you're in a down market, if there's a mistake, it can be more painful. If you're on an up market and you make a little bit of mistake, the tide is rising, so everyone kind of rises with the tide. But again, I think it's important that people kind of put this in and analyze these buckets and analyze these places, really dig in deeper than just the metro as well. We like to go down to the micro level. Sometimes counties, if you can get that at county level, or even lower, because not, you know, the metro may be doing one thing, but there may be something going on below that. So this is good information, and I think you have to understand it in the scope of things. So Stefan, my first question, and I'll let some folks, I think there's some people that have some questions, if you can put on the chat or jump in, going back to your original piece where you were talking about some of the data scraping and getting the data that you need to sort of make the analysis happen. If you have a paid service on the commercial side, let's just say Yardi Matrix, that's one that we're using. Is that in and of itself enough? Because it does connect to a ton of the APIs that you mentioned. Being able to use that product is enough to make sure that we are looking at the right kind of data?
Well, yeah, I do have. So yeah, it's like right the second one here. So commercial multifamily kind of lead generation or lead prospecting data, if you will. I mean, I don't want to say it's enough. It's just doing something a little different from what is, let's say, in CoStar. Because in CoStar, like so you probably are better off if you still have CoStar, but that doesn't do modeling for, you're not gonna get an intuition for which buildings, it doesn't have financial intelligence, basically. It's got incredible data on everything, the biggest one, but there's no financial intelligence for which commercial multifamilies have the bigger potential that you raise their net operating income. And that's what our offering, yes. So if you go to like realtyquant.com/analytics, is both our products are there and the commercial one as well. And yes, so we kind of offer feeds of that. So, or like, that they keep getting refreshed and so forth. But essentially, like which buildings have rents below market, things like that, or which buildings also are not charging pet fees, perhaps, which buildings are underutilizing their utilities and so forth. And so that's something that the data for that, who possesses the most data for that? Well, that would be CoStar. But do you have modeling of that data? No. And so that's where we come in kind of for modeling, rental listings data and inventories to actually derive insights. So that's the value now. To your question, is it going to help them with all their commercial multifamily needs? No, I mean, you probably need other stuff as well. But what we do is we kind of give you a feed of the properties in the market. So sort of, if you think of something comparing it to Prospect Now, let's say, if you have something like Prospect Now where you have like the feed of properties, but you don't know anything much about them, like you may get a sense maybe for motivated sellers, something people look at sometimes, but you don't get anything about their financials in a way. And so where we come in is it's like kind of Prospect Now, but sorted by the best ones, kind of the best ones for a value add investor. And so kind of it's a financial intelligence on top of commercial for commercial multifamilies marrying with rental listings data. It's something, it's what I use for my direct owner campaigns. It's just essentially extra intelligence on those. And so that's, I don't know if one is able to get it anywhere else. I have not seen it. That's why I had to build it kind of for myself. So to my knowledge, we're the only ones who offer financial intelligence on off-market commercial inventories.
Okay, good. All right, thanks for that. I'm going to hold to see if there's anybody other questions. If not, I've got some other ones, but I want to give the crowd a chance to ask. So open mic.
Hi, Stefan. This is Vessi. Great presentation.
Hey, Vessi. Good to see you.
Great to see you.
I see you sometimes at our webinars, actually. Thanks for joining sometimes. And on Facebook as well.
Yes. So really appreciate it. Quick question, is this supply and demand absorption, is that all factored into data as well, or is it something
right? Yeah, that is a really good question. And so yes, but depends on which kind of, you mean kind of like housing supply and housing demand, let's say housing shortage in a way. Yes, but like I feel like this kind of language for housing shortage kind of gets used to refer to many different things. So okay, someone is referring to like new homes shortage and like under construction and like other definitions and so forth. So it depends. But this thing here is like, if you look at the overall market and say you go in census, like US Census Bureau, and you look at total number of housing units, and then you look at also the total population in an area, be it a county or a metro area or state, etc. And it is reflected, yes. So here, these metrics, they kind of, they change with population and housing supply, actually. And so, so it's kind of, but it's the total one. It's not the one it's not the listings one. It's not, if we have, how many listings we have on the market available, and there is a shortage of listings versus demand, let's say. It's not this extra portion, and it's not also new construction or so forth. So again, I don't model those to too well understand, but my sense is I actually model housing shortage in terms of population housing supply ratios in all these markets. And actually our data, it shows that. We have it as charts and how it's evolving and so forth in our reports. And so housing shortage on this global level, again, like what is it for the whole market, is reflected. And one way I can say how it's reflected is if you want to like compute, the simplest way to measure overvaluation is to track affordability on a kind of moving average window. And I've shared that like many times. That's like the simplest way. So if you want to do it more complete, you include population housing supply. But if you want to do it in simple, it's just affordability. So only incomes. And so, but the interesting thing is as you do this, you're not tracking only affordability, because you're tracking the change in affordability, and actually affordability changes with housing shortage. And so what happens is that, let's say you have a price income ratio in the market of, let's say 8, let's say home prices are 8 times incomes. And then suddenly, 10 years later, it's now 12. Well, what happened is, and that's what happens actually in some big metropolitan areas, what happened in the past, like San Francisco and New York and so forth, is that, okay, affordability shifted up because housing shortage developed. But because here you're tracking a deviation from this moving average window, you keep accounting for housing shortage actually. So it's an approximation that works in that scenario. So yes, actually it is reflected. And so that's, so for example, you have Phoenix, and if in Phoenix more population to housing supply ratio, shifted, towards shortage essentially, right? That's gonna be reflected. But it's not the new construction one, and it's not the listings on market. So those are just different variables that to me, they're not very fundamental kind of in the first place, because they're a little noisy. Okay, just what does it mean? How many listings we get on market? So one would say, okay, that's what drives the new prices. Okay, you can think about it like that. But this is more like fundamental analysis. And so, yes, total housing units, total population divided by total housing units is what this is reflecting. I've been doing this study like with few different methodologies. In one of them, I actually literally compute the housing shortage, like population to housing supply, and regress that in the study. So on one side we have income, and on the other side we have housing shortage. So I'm aware of that, and it tracks that. And that's not a factor that I know all investors, because the narrative now is, okay, we're not going to get a particularly negative scenario because there is housing shortage. I think that could be true for different reasons. I mean, I'm not sure. In a way, like it could maybe have some effect of bringing more declines that listings housing shortage, but the total market housing shortage is reflected, and that's not going to be a reason for prices to decline or not, because that's already here. And so if something is overvalued relative to that, it's reflected. Yeah. The listings one, yeah, I don't know the effects of that, where in some way that could be bringing for less volatility in the market or something like that, just because you have so much shortage. Assume it brings less volatility. You could also have fewer, you have to keep in mind that demand pulls back in a recession. So I don't know what, again, that's something I don't track on that listing, but demand pulls back as well. And so I don't know what the relationship of the two is going to be then. I just feel it's a noisy variable. I feel it gets like a little bit spoken too much about. And I get it, but it's not so meaningful to me. On the, again, like US Census Bureau population housing supply, many markets don't have shortage, Many markets are going the other way. If you track, I have the charts in different markets. If you look at total population to housing units ratio, in some markets it's going down, in some markets it's going up actually. And on a historical basis, it's been kind of hovering in the 1.75 to 2.25 range. So let's say, so like 2 people per housing unit, roughly speaking, or like 1.75 to 2.25 people per housing unit. And so that's kind of where it's been. And it's that's not gonna prevent that in any way. But again, that's not also pointing, this is not forecasting, is also another thing, because this here, I'm not saying if we're gonna get any scenario, because I don't do economic forecasting. It's not my job. I'm not even an economist to do economic forecasting. I don't know which scenario is going to happen. I just measure as kind of a finance person. I measure where things are right now. And okay, now then we can be at the mild scenario. We can be at the severe one. We can be somewhere in between. We can be maybe at a slightly different scenario. But this gives you insights into relative performance, because, you don't get like a table, like I said, like for this one that is like perfectly ordered across time and magnitude in an asset that is overly complex. You're not going to get that one if you're studying technology stocks. And the reason why we get it is we have this incredibly simple asset of real estate that is very fundamental. It's like studying utility stocks in the stock market or something. It's like investing in PSENG, so it's kind of easy. And so we're actually kind of blessed as real estate investors, because like there tends to be like this kind of thinking that market analysis is so complex in real estate, and like thinking we're just taught by the stock market that those are some kind of stochastic weird things. I mean, they're stochastic, call it, but they're not some kind of like unpredictable stuff. Well, in reality, there is a lot that we can understand if we are in real estate compared to the stock market. So.
All right, good answer. long answer. It was good. It was very detailed. That's exactly the kind of information that I think is useful. I mean, it's easy to kind of throw one sentence answers, but this is a very important stuff. It's a lot of money on the table for some people. It's good that we understand it. Other questions? I was going to actually ask you about forecasting. So you got that. I took that one out. I'll scratch that one off, and I will ask another one. I have
forecasting. I want to actually answer Ray. I do that. I think just like ahead of a recession, it's not very useful because it just gets so overshadowed. Like the way otherwise you do forecasting is, I take again like those fundamentals, income, population, housing supply, and try to forecast prices. Now, if we're further into the market cycle, it's good to be forecasting only prices and not the fundamentals. And those are other studies I've done. I've showed like in the past where if you're forecasting if you're investing in the markets that are doing really well, and you just picked them based on their historical performance, you actually commit like a 5 times smaller error than if you're trying to guess them by their population growth, income growth, and housing supply, let's say. And so it's actually interesting. So one can forecast things. And so I had done like forecast, let's say at the state level, just as a test for like 2018, 2019, and it was within like less than 1.5% error of the true price growth. So once the trend persists, but then it breaks, then comes like 2021 with inflation, and then your error is suddenly now like 6% or something, which is huge. So now it's too big. And so you can forecast stuff, you are able to. It's just fundamentals, they don't really matter if we hit a recession. It's all, and we had a very overvalued market ahead of time. It just
I think the key is that you have to lock these things in for long term. I think where people get hurt is when you got these short-term bridges and you're expecting appreciation, you're expecting low caps, and all of a sudden the tables turn, the timing isn't quite right on your forecast, and now you're left holding the bag. The idea is you kind of invest in longer term loan products that will allow investor or the people that control the asset to figure out when to best sell it based on what's happening right now, because recessions will go a year, 2 years, maybe 3 years if it's severe, but you just want to make sure you're outside of that cycle so you can turn it around and have some better choices to make. I think that's where people really get hurt, is when they try to when they're really gambling versus investing.
Right. Yeah. I mean, I agree. I mean, that said, real estate, it's also not like, doesn't seem to be like very it doesn't have the biggest downside risk. It's like very sticky to the downturn, right? It's like prices don't really decline all that much often. But I agree, yeah. And you can have your specific property decline value or your specific neighborhood, and like, on a more micro level, right? To your point before, and yeah, you want to be protected from that with your choice of financing, I guess, things like that.
Yeah. And I'll make one comment, and I don't know if there's any other questions, but obviously they can jump in. On your Florida slide, it was very interesting to me. What I saw was the Gulf side of the state really having some difficulties. I guess Lakeland can be a little bit outside of the Gulf. If you think about it, it's kind of in between Tampa and Orlando. But you look at all these and they're on that Gulf side. So it's interesting that you have those there. And then you have some stuff in the central part of the state that seems to be, at least from your analysis, from the data, looks to be in a better position. And then I know you don't have Miami here. You thought Miami was decent as well.
Miami was actually right, was right above the bottom 5.
Okay.
Miami is closer to the bottom than the top, actually. So it's
well,
been like that.
That's what happens in Florida. Florida kind of goes up the coast and goes into Jacksonville, and then it goes to Tallahassee, and that's kind of how it burns, from a real estate cycle almost.
I think Miami is being, I think like that's an example of where one can say like some of those arguments of, the market having very strong fundamentals. I guess it's being like extremely strong in fundamentals too, besides its price performance. That was the case in 2020. The county that contains Denver So it was perhaps like in the top 5. But at the time, if it was fairly valued, it was right at 0%. If you were looking at its appreciation alone, one could think that's probably already very overvalued because prices have appreciated so much. But actually, it's kind of joint fundamentals of income, population, and housing supply were in line with that. And so Miami is more in line than Tampa is, for example. But again, I'm not going to be overly promoting Miami because it's obviously above 28% overvalued because the bottom ones are, maxing out at 28. And so, so that's kind of story there. But yeah, it's less. And in fact, Miami was close to fairly valued, like pretty recently, like if we go like over a year back and so forth. And so is New York. By the way, that's like the other examples. Sometimes people think that markets that are not affordable, they carry a bigger downside risk. That couldn't be further from the truth. Some of the least affordable markets right now have some of the lowest downside risk. Now, well, I don't want to speak to San Francisco because that's getting conflated by its massive population outflow. So that one is even seeing some price downturn potential on its fundamentals, apparently, just because population is massively leaving San Francisco. But, and there's an extent part of that actually in New York. And now in Manhattan, that's like very much the case. But New York at the current time, it's fairly valued, and San Francisco is actually undervalued significantly. And they're very not affordable place because it's not about absolute affordability. So you have to think of the market dynamic. It's like the state of California is the least overvalued, by the way, Western state this cycle. It's been the most overvalued ones ahead of both recessions, one of the most overvalued ones ahead of both recessions we looked at. Ahead of 1990 was at the peak. Ahead of global financial crisis was at the peak. At the current time, it's not. That can align with your investor intuition, because I am an investor myself. I don't can't just do analysis, but I've been doing this study for myself for 2 years, right? And so essentially, I do make sure kind of, does it align or not? And so California, the narrative, as we know, has been, okay, it's very expensive. It's a democratic state. The policies are not favorable. Let's invest in everywhere else in the West. And that's how Idaho became the top booming state this market cycle. Like, who would expect Idaho to be like so at the very top, the top performer, or something like Boise, Idaho to be the #1, right? In price appreciation, which it has been, but it just happens to be kind of a smaller Western state, and also kind of maybe being smaller on average, it appreciated a bit more and so forth. But California was, until like a few quarters back, the only fairly valued Western market, and now it's also a bit overvalued since things got very overvalued kind of across the board. And it's because everybody said, okay, we let's invest in Nevada and Utah and Arizona because they are cheap and California is expensive. And now California is still absolutely more expensive than they are. But now California is relatively cheaper and they're relatively more expensive. And so that's kind of, so overvaluation is not a function of absolute affordability at all. Another way to see this is, okay, you can have cities that were, let's say, their incomes, their prices were 15 times the personal income in that city or something like that, and you can get a recession. And if that ratio, though, is consistent with the history, if it didn't excessively increase, and relative to also how housing shortage develops there, that city is not going to decline in prices at all, and that's normal to expect. So it's basically deviation in affordability that drives downside risk. It's not of absolute affordability. It doesn't do anything. And so that's kind of like having those charts of price income ratios of different markets and showing that is actually, I think, meaningless, because I mean that can give you a perspective to like something else, like the market, some slowdown in transaction activity or something. It's sort of like, I guess, mortgage affordability now and things like that. But those are not statistically the market that show downside risk. And so, yeah, so that's against an example. New York is now fairly valued. It's because nobody wants to invest in the Northeast. And everybody's running away from that. And everybody's investing to the South and the West.
Yeah, it makes a lot of sense.
Yeah.
Any other questions out there?
Yeah, Stefan, great presentation. Thank you.
Thanks, Mike.
I have a question on your automated underwriting tool. So
Sure.
for me, currently underwriting, I take a lot of time underwriting some of my deals. Maybe if you can speak on at which point does the human interface come into play?
Sure.
So I know you can't input your rent roll, your expenses, entirely automated, right? I mean, how do you
That's for
automate that?
residential or commercial?
Commercial.
Commercial?
Yes.
Sorry, commercial, right?
Commercial.
Okay, so for commercial, okay, well, so, and do you care to look at like anything that's on market that's let's say maybe on Craigslist or other places, or you don't, you just trust that there's not going to be ever a deal there because you want to look at, it depends on your deal size, I think, because if you're looking at like 200 plus units, right, okay, it's agent relationships, but if it's 50 units, then maybe no.
Sure, it'll be all options, right? Keep the pipeline flowing.
Got it.
It gives you a good pulse on the market.
Right. I mean, so my approach, that's kind of what I'm doing now. So I have like a small team of like kind of pretty junior people who basically are relatively like young people, okay, let's say, who are basically helping me with the human part. So what you're saying, right? So that you need that, yes. Because what I've been doing like before, like some of the challenge for me is, okay, I build these data-driven systems. That is an expense of time to you, and you need to maintain them. Because if you wrote all those scripts, let's say, I don't know if you're into Python and things like that or no, or you just—
I understand the language.
Okay, sure. So let's say you wrote like all this Python code, and now you've got like 5,000 lines of code or something, and now suddenly you need to maintain. It keeps breaking, and you suddenly got yourself a job of maintaining those systems that are designed to serve you to a higher level, but in reality, you're not getting enough deal focus. You're not closing with the human aspect subsequently. You don't have the human capital to close that off. And so I think that's like a challenge. And so that's the way I've been working to resolve it, for me at least, is, okay, let's get like few like kind of like more junior analysts who are able to take on this partially underwritten data. And suppose you're underwriting, let's say, even WhoopNet or Craigslist deals, or suppose you got deals from whichever sources you got them from. You can get them from social media, for instance. That's one process that we have, be it like Facebook and so forth. And let's say you got like those deals, and you have them partially underwritten by your models. They pull up by zip code what are the rent estimates in those areas. They kind of try to gauge like how much percentage value add you can have and all that, and compute cap rates, compute, let's say, for your financing scenario, some kind of cash on cash returns and so forth. And so then you need like someone to pick this up and be able to, speak to the other side and understand the physical aspects of real estate and kind of close the deal for you, or close the whoop, right? Because otherwise you're going to be building too much data, which has been, I can say, like from my own experience, like an example, because you kind of take on a more ambitious project. You take on, oh, I want to be doing it a better way. But that better way takes maintenance, and it requires somebody then to be dealing with the human side. Essentially, somebody to be calling agents and clarifying, okay, we are seeing, let's say you're seeing like a very favorable upside in rents and kind of upside in net operating income in your model, and trying to call and like clarify that and so forth. Now, other aspects are, for instance, let's say maybe you want to score conditions for those persons. That's something also that I've been doing, which is I would pull like, okay, this is showing something else, but okay, I would try to train models on property descriptions and kind of do like basic natural language processing. I've been using TF-IDF, but I need to switch to BERT, which is way better and more powerful. And kind of like classifying, you need to get like people to classify properties for you for the initial training set manually, and kind of classify, okay, based on descriptions on commercial properties can be, let's say, that are given by agents, what kind of condition you're expecting. Okay, maybe this one is a little more useful on the residential side, to be honest, but you could also use it there. But yeah, there's an aspect of condition scoring, and there's an aspect where you may want to do a little bit of machine learning to classify for instance, I pull social media, try to pull like commercial multifamily from social media and to kind of look at those. But which ones are commercial multifamily ones and which ones are, okay, people are saying that I already am exiting this deal and something like that, right? And so you need to train like a model to detect, like to do like textual. And it's not, this thing is like to people who are like, who work at Google or something, this stuff is like so basic already. Like the kind of things that are done at this moment, like the kind of, I don't know if you've seen like Mike, they had like, I first saw it on LinkedIn, but well, I don't know if you guys follow, like there's like these algorithms, like Dolly 2 is one that does like text to image, you know, like we can, for instance, with my daughter, we wrote, okay, in OpenAI, we wrote, okay, if you want to have, let's say like a pink cow jumping with a party hat in amongst the clouds or something like that. And then it can draw the image of that for you and generate images for you, right? Like the algorithm itself. So it kind of, it's creatively painting images for you from the text that you wrote, right? And so, okay, that's not an application here, but I'm just like, I'm getting to it. And so, and then we added, then like with my daughter, we added, okay, pencil drawn can be that painting. And then it draws you a pencil drawn painting and so forth. So these things got so advanced, but the application that is like to this stuff that though it's not open source yet, is large language models. So what you want to have is not just this condition scoring and computing stuff for properties. What you want to have is a model that's going to train on the analysts of that commercial real estate firm. Is going to take their analysts' work, what properties they're underwriting and what analysis they're writing up, and that it's going to be able to recreate it in a creative way with insights and trained on their exact data sets of how they underwrite their deals. Like if they do it conservatively or not conservatively and so forth. And that may sound kind of wacky, but it's actually, it's just that those libraries are not open source. But what Google does with, so they have a collection of models called Minerva. And there's another one that's called like PALM, like Pathways Language Model. So those, for example, they seems like they're able to do that. It's just somebody hasn't, like a startup hasn't taken to do that application. And when that happens, is then you're not going to need like all these analysts underwriting, all these underwriting people being paid like sometimes high salaries to do it and so forth, because you would be able to kind of train a model to do it. And yeah, so an example where that was implemented like Minerva or like PALM kind of language model was solving undergraduate science problems, for example. But that solving, it's not okay just solving, it's actually writing up the solution. So that's like perfect creative analysis. So it's creating text also. It's not like only analyzing like here, let's analyze deals. That's like pretty basic, like what I do, you know, for instance. It's like more advanced. It's actually, let's get, you know, let's actually creatively write up the solution. And so whenever one can creatively write up the solution to an underwriting question according to the requirements of like a specific investment firm, then it's like the investment industry is basically changed and it's done and kind of needs to fire all its personnel. But it hasn't happened yet. And so whenever those libraries become open source, perhaps companies like mine, by the way, and others, you know, I'm going to be kind of looking for that to let's try to build it and so forth.
Okay, thank you.
But that's like, yeah, I mean, you need the human side, I think.
It's not a refined system yet, although everybody is working towards something that would give you an answer, right? I think that's why people can still make, you know, some money in this business because you know it's not just pure data. You do need some interface there. Any other questions?
Not pure data at all. Mm-hmm.
All right. Well, I have one last question, and I guess before we close out, I just want to remind people it is late. I'll stick around a little bit for anybody who wants to chat afterwards, but our next show is on October 17th, again, the third Monday of every month, and looking forward to seeing you there. We will post this to my YouTube channel so you can see that as well if you want to study this in detail. Some of this stuff deserves to be studied. I mean, it really is, you know, very, very good analysis. And Stefan, I do want to thank you. My last question, and then we'll go there, is one of the things that's kind of changed this cycle that, you know, at least from the previous cycle where we had a major turn, you know, in the 2006 or so, right? That time frame is that we have a large group of institutional buyers going after single family. You have Blackstone, you name it, it's there, billions of dollars. And so part of what made prices drop as much as they did previously is that people started, essentially you had the foreclosure crisis and you had people that essentially had to get rid of it. So prices just went way down. What a lot of people are saying that's going to happen now that's different is that because you have these institutional buyers that don't necessarily have the same pressures to sell that a lot of people, the individuals did, it's going to help keep prices more inflated than previous. It doesn't mean it's not going to drop, right? We think, we're seeing that it's already dropping, but it won't be as dramatic because you do have that large chunk of capital that's not sitting concerned about whether it goes up, down, in the short term. They're more looking long term.
Right. I mean, I think, so that's a kind of plausible kind of guess or I agree. And like also housing shortage is another argument we've been seeing for like milder declines now. And then also the lack of excessive lending is another argument we're seeing and so forth. But my personal view is again, like I'm just trying to get to like that big table is again, my personal view is how big real estate declines is a function of it, seems to be a function of it, how overvalued point to invest and just how strong the recovery is. And I don't think it's so much a function of all that other stuff, such as like even global financial crisis. To me, it's not, we got that excessive lending is what drove the overvaluation. You can get, it's like you're explaining the error term. It's like your error term, you can have a million reasons to explain it. I don't know what those reasons are. Are they excessive lending then? What is the reason now with inflation, let's say, right? And so forth. But then that's just driving the error term. But to me, what drives the declines afterwards is once you measure that error term, how overvalued the market is, the only thing to me that drives the declines is how strong the economic recovery is. So that's for economists to forecast like income growth and stuff like that. I can't do it because they don't know how can I forecast income growth, let's say. But essentially to me, it boils down to this. If you have a good recovery, those overvalued markets, they'll decline less on a shorter, not on a shorter duration, unfortunately. As we saw, the duration can be pretty long. But yeah, I don't think that's the way to think about it. I know I hear these arguments a lot. I don't think it's, did we have excessive lending? Is it the market, you're saying market structure, let's say, is the market comprised of more institutional buyers, they're not gonna sell? I don't know. I think that's like a very technical, non-fundamental little bit argument becomes, and it's a good one. It's very reasonable. But again, like I say, to me, it boils down to valuation and economic recovery.
Got it.
And that's kind of like a little bit of a new idea that even myself, for me, was a little bit new from looking at like tables like this one, because it really kind of comes down to, you can invest in a very overvalued market, right? But you're not going to get a very big decline if you get a strong economic recovery. And so that's about it. And actually, there was a question from my friend Angel asked before. I'm not sure. I think we missed it. She was asking on the chat. I saw a question on basically, is there like a correlation with decline duration and what the recovery is? And so, I mean, yeah, to the extent of if you get a very high decline duration, that things are stagnant or slightly declining for a really long time. If we say your recovery is kind of your relative performance 10 years ahead, it does get affected by that for sure. So yeah, so there is a correlation, even kind of by this table, that the longer your decline duration is, generally the worse off you get on a 10-year horizon. But yeah, it's not like the biggest. It's more like, again, it's more like, I think with what valuation you invest that is important. So.
Okay. Yeah, I missed that one. Sorry, I think she took off too. But
no, no worries. No, I think it's okay. I just saw it myself. I missed it too.
Okay, no worries. She'll get the recording.
Yeah.
All right. Well, listen, very much. It was very much appreciated. I appreciate the different perspective. I mean, this is not just about, telling people the best stories. This is about, there is risk. Anytime there's investing, there's risk. I mean, there's up and there's down risk. You put your money in the stock market, there's risk. You put your mark under the mattress, there's risk. So it's a function of how to reduce the risk and investing where it makes sense, which is what this show is about. So this was very good. I encourage those that are here to make sure that everyone else gets a chance. Push that out. As soon as the link goes out, if you can push it to others, I think it's a good story. It's a good story for everyone to see, and it can't always be rainbows. And there has to be some balance. That's what makes a market go. I mean, if it's always an up market, it doesn't make any sense. I mean, you got to have ups and downs. How do you operate within that space? And that's the key. So, Stefan, I can't thank you enough. Thank you very much for your time. And I'm going to stick around after this for 10, 15 minutes in case anybody wants to chat. So until next time, remember to invest where it makes sense.